The relation between stock exchange and economy is like a man walking his dog. The man walks slowly, the dog runs back and forth. This is Costolani's description of the animal spirits of the stock market. We can never be sure what it will do next. It's not always explicable and, at times, it may bear no relation at all to where we think it should be going. One must not believe that others, when they massively buy shares, know more or are better informed. Its causes can be so different that it is practically impossible to draw consequences from it. Costolani was no stranger to stock market bubbles. He was one of the few who had the foresight to short shares in the run-up to the 1929 crash. Here he warns us not to get sucked in by FOMO, equals fear of missing out, during a market mania. Stock market profits are compensation for pain and suffering. First comes pain, then comes money. Costolani reminds us that market risk is not only real but also the source of long-term equity returns. Ultimately, we can only profit from stocks by being prepared to bear the risk of reversals. https://www.dieinvestor.net/10 Quotes that explain the stock market /#::: text equals %E2 %80 9 cone %20 could %20 win. The %20 market %20 recovers. Who does not own shares when their prices drop, will not own shares when prices soar. Building on his theme of being able to take the pain, Costolani spells out the courage that's required to buy stocks when they're on sale. Profitable opportunities are typically greatest after a market meltdown, but you're liable to lose out if you're just sitting in cash, waiting for signs of a revival before investing again. The bargains are usually gone by the time it's obvious the danger has passed. You have to buy shares in a recession or crisis because the government will manage the situation by lowering interest rates and injecting liquidity. Costolani did not witness the era of quantitative easing and negative interest rates, but this wily observation explains why he believed investors should always stay invested. We only need remember how the central banks blasted their bazookas to restore confidence during the pandemic to realize how far-sighted he was. The one who has heaps of money can speculate. The one with little money must not speculate. The one with even less money must speculate. Here, Costolani addresses why your wealth-building plan must be tailored to your circumstances. The very rich can afford to lose money. The worst off are forced to take large risks. Those in the middle should avoid the urge to swing for the fences and stick to a sensible, balanced strategy that will grow your wealth in the long term. Buy stocks, take sleeping pills for 20 years, and stop looking at the papers. After many years, you will see, you'll be rich. The old maestro knew that most people cannot stand following every twist and turn of the market. Stock picking is stressful, but there's a better alternative, a buy and hold ETF strategy that can be left alone to grow. Our favorite holding period is forever. For the last quote, let's see how Buffett sums up his long-term investment philosophy. Our favorite holding period is forever. This is a good reminder to invest for the long term. There will be market corrections, market crashes. Keep your eyes on the destination and you will do fine. Even a reasonable growth rate can compound your wealth. Only when the tide goes out do you discover who's been swimming naked. In one of his more colorful metaphors, Buffett remarked, only when the tide goes out do you discover who's been swimming naked. During a bull market, even poorly managed companies can look strong as their stock prices rise with the overall market. However, market corrections act as a stress test and reveal the vulnerabilities of weak companies. To protect your portfolio, Buffett advises investing in companies with solid fundamentals that can weather market downturns. The most important quality for an investor is temperament, not intellect. Buffett once said, the most important quality for an investor is temperament, not intellect, emphasizing the role of emotional stability in successful investing. This emphasizes a crucial but often overlooked aspect of investing, emotional discipline. Market corrections can be stressful, leading many investors to make impulsive decisions driven by fear or greed. And sometimes, having a high IQ doesn't help our investments. As a bonus, here is an additional quote from Charlie Munger. A lot of people with high IQs are terrible investors because they've got terrible temperaments. And that is why we say that having a certain kind of temperament is more important than brains. You need to keep raw irrational emotion under control. You need patience and discipline and an ability to take losses and adversity without going crazy. You need an ability to not be driven crazy by extreme success. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. Like the previous quote, Buffett's value approach is perfectly summed up in his saying, whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. Regardless of your investing style, You can always buy stocks at a discount. During market corrections, even the best company stocks can drop in price, often due to market sentiment rather than any real decline in the company's fundamentals. For Buffett, these moments are like a sale in a department store, a chance to buy great products at reduced prices. The best chance to deploy capital is when things are going down. Another quote to add to this theme. The best chance to deploy capital is when things are going down. Buffett has often highlighted the importance of investing during market downturns. Simple quote. Simple message. Take advantage of volatility. In the business world, the rearview mirror is always clearer than the windshield. Investing is about making forecasts. And it's always obvious when you look back at an investment. In the business world, the rearview mirror is always clearer than the windshield. It's easy to look back and understand what happened after the fact, but predicting the future, especially in volatile times, is much more difficult. Even in the past week, we've had a major shock in Japan that impacted the world financial system. This brings a lot of uncertainty in the market. Investors who try to time the market with these macroeconomic events often end up making poor decisions based on incomplete information. Instead, Buffett advises focusing on the fundamentals of businesses and staying the course, rather than trying to predict short-term market moves. The stock market is designed to transfer money from the active to the patient. One of the pillars that have always helped Buffett's investment strategy is patience. He once said, "The stock market is designed to transfer money from the active to the patient." This quote highlights the importance of taking a long-term view in investing rather than frequently trading, especially during market corrections. Many investors, driven by fear or greed, act too quickly, often selling low and buying high. Buffett, on the contrary, advocates for a patient, long-term approach. By holding your stocks for a long period, you will benefit from the eventual market recovery, you will pay less transaction costs, and you will sleep better at night. Opportunities come infrequently. When IT rains gold, put out the bucket, not the thimble. Buffett is famous for seizing opportunities when they arise, especially during market downturns. He famously said, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." This captures the idea that when the market offers a rare opportunity, you need to act decisively. Don't be shy when you buy. If you strongly believe in this stock, buy big. During corrections, the prices of high-quality stocks are beaten down, not because the companies have changed fundamentally, but because of general market panic. People on TV talk about the negative economic outlook. You read bearish articles about your favorite stocks. If you've done the work, it's your duty to take advantage of these opportunities. It's not about taking excessive risks, but about recognizing when the market has overly discounted the value of good businesses. In the early 1970s, Buffett saw such an opportunity with the Washington Post, which was undervalued due to market pessimism. Everybody thought that the Washington Post was doomed to fail. But Buffett invested heavily in the stock, and eventually, the company navigated this uncertain period, and this generated significant returns for investors. Price is what you pay. Value is what you get. Another core principle of Buffett's investment philosophy is the distinction between price and value. He often reminds investors, price is what you pay. Value is what you get. Our goal as fundamental investors is to analyze businesses and determine the intrinsic value of a stock. When markets drop, too many people focus on the prices going down. But what about the intrinsic value of the business? If the business is improving during challenging times, the intrinsic value may rise. So there is a mismatch between the stock price and intrinsic value. This creates wonderful opportunities in the market for long-term investors. A lower share price doesn't necessarily mean a bad investment. It can actually be a great opportunity to buy a valuable asset at a discount. Be fearful when others are greedy, and greedy when others are fearful. In his 1986 letter to Berkshire Hathaway shareholders, Buffett wrote, "What we do know, however, is that occasional outbreaks of those two super contagious diseases, fear and greed, will forever occur in the investment community. The timing of these epidemics will be unpredictable, and the market aberrations produced by them will be equally unpredictable, both as to duration and degree. Therefore, we never try to anticipate the arrival or departure of either disease. Our goal is more modest. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful." That's perhaps his most famous quote. This advice highlights the value of contrarian thinking in investing, especially during market corrections. When markets are only going up, and everyone is optimistic, prices often rise far above their intrinsic values. And this creates bubbles. On the other hand, during market downturns, Fear takes over, everyone is panicking, causing stocks to become undervalued. This situation allows you to buy great stocks at a discount. You just need confidence in your analysis and courage to pull the trigger. The best illustration of this point is the 2008 financial crisis, when Buffett invested billions in banks when everyone was scared to touch them. He stayed calm, rational, and took advantage of this opportunity. Learning to love markdowns is critical for long-term investment success. Key is the ability to retain the perspective that markdowns represent the opportunity to buy an additional stake in a business at an even better price, and that a markdown is a loss only if you sell. From this vantage point, what seems on the surface like bad news is actually a positive development. Obviously, in the face of a downdraft, it is incumbent on investors to regularly check their analysis and reaffirm their conclusions, especially in the face of sudden and surprising price declines, to assess whether the price action may reflect important information, either of new developments or information that your own analysis may have missed or misunderstood. Seth Klarman. When stocks get cheaper, how can that not be good news for a long-term investor? There are very few times when you should be bold, and history shows that those times are precisely when it seems you should be most afraid. It's absolutely cockamamie crazy to sell stocks after they drop. Instead, you should say, "Today there's a first-rate bargain and I'm buying." Charles D. Ellis. Investors today are faced with an easy choice: fretting over the short-term prospects for the economy and the market, or taking the longer view that recessions and bear markets present excellent long-term investment opportunities. It always takes courage to invest in depressed markets, but if you focus on fundamentally sound businesses trading at bargain prices, your courage is generally rewarded. Mario Gabelli. Occasionally, weak markets and rotation challenge our confidence, even though we've done the research and try to maintain our long-term perspective. They stir up the fear bug in all of us and make long-term investing seem a lot harder than it really is. We must keep in mind that markets tend to rise more than 2/3 of the time, and that those inevitable periods of rotation pass. Bill Stewart. It is a market truism that the seeds of outperformance are planted during bear markets. Eventually, stocks will be priced according to fundamentals and the economics of their balance sheets. Those that have the courage and discipline to invest in sound companies during calamitous economic conditions reap the rewards. What matters in stock picking is not buying at the right time, but buying the right business for the right price. At some point, probably before economic headwinds have abated, panic buyers will stampede into the market fearful that they will miss the bounce after experiencing so much wealth destruction. Jake Rosser. The Chinese phrase for the term crisis means both danger and opportunity. When the overall market recovers and fear subsides, both genuine opportunities and the traps often provide large short-term gains. But these short-term results mask the true risks, as few can tell whether the good results stem from prudence or luck. Li Lu. My philosophy is that life is not about waiting for a storm to pass. It is about dancing in the rain. One usually can read a weather map and reasonably predict when a storm will pass. If one waits for the moment when the sun breaks out, there is a high probability others already will have reacted to the improved prospects and already driven up the price of the stock, and thus the opportunity to earn large profits will have been missed. Ed Vakenheim. You know the pros: maintain buying reserves until current uncertainties are resolved, etc. Before reaching for that crutch, face up to two unpleasant facts. The future is never clear. You pay a very high price for a cheery consensus. Uncertainty actually is the friend of the buyer of long-term values. Warren Buffett. The triggers might be different, but the result is always the same. Market crashes are followed by recoveries. While the oft-quoted investment maxim that past performance is no guarantee of future returns remains as true today as it has ever been, a brief look at history can serve as a reminder for investors to hold their nerve, take a long-term view, and ride out short-term volatility. Bailey Gifford. Drawdowns are no reason to be unsettled. To the contrary, if share prices never fell, there would be less opportunity to buy companies cheaply. Higher long-term value creation in return for some short-term discomfort at a price decline is a trade every business owner should be happy to make. Robert Vinnell. We want to own a stable of great businesses, particularly when there's a moment of dislocation, or a question of doubt about something, or a perception of a competitive threat that we think is being overplayed in the market. Those often give us the opportunity to own great businesses at more reasonable prices. Kelly Granat. Another valuable investment secret is that the owners of sound securities should never panic and unload their holdings when prices skid. Countless individuals have panicked during slumps, selling out when their stocks fell a few points, only to find that before long the prices were once more rising. J.P. Getty. Corrections tend to occur every couple of years, and the message from the media is always, now that the market is down 10%, you should start to be scared and become more cautious. As usual, that's a day late and a dollar short. If it feels like you read a "don't panic" in a correction commentary from me every couple of years, that's because that timing is about right. So, spoiler alert, the analysis that follows will lead to the same conclusion it always has. Don't panic, sell after corrections. Bill Nigren. Large price declines across the board should attract your attention. A good rule of thumb is to sell during times of market hysteria and buy during times of panic. Always remember to buy low and sell high. It sounds so simple, but it is extremely difficult. Just keep this dictum in mind, especially when your emotions are getting the best of you. Jim Rogers. Declining stock prices can ultimately cause people to panic and sell. But the moment they join the panic and sell stock, they also relieve the cause of their fears and become potential buyers. The act of selling removes the anxiety, restores equanimity, and gives them the cash to buy. Leon Levy. Investors who expect to be ongoing buyers of investments throughout their lifetimes should adopt a similar attitude toward market fluctuations. Instead, many illogically become euphoric when stock prices rise and unhappy when they fall. They show no such confusion in their reaction to food prices. Knowing they are forever going to be buyers of food, they welcome falling prices and deplore price increases. It's the seller of food who doesn't like declining prices. Warren Buffett. The optimal time to purchase securities is during periods of market collapse, when Mr. Market indiscriminately offers discounts on great and poor businesses alike. Unfortunately, it's during these same periods that fear tends to cause an investor's confidence to fall just as quickly as their portfolio value. Luckily, for the astute investor, the simple prescription is knowledge. The more knowledge an individual has about a situation and the drivers causing it, the more confident they will be in their derived conclusions. Conducting months of research certainly makes it much easier to have conviction in an idea, especially when the world is seemingly going off the hinges. Fred Liu. Most investors take comfort from calm, steadily rising markets. Roiling markets can drive investor panic. But these conventional reactions are inverted. When all feels calm and prices surge, the markets may feel safe, but, in fact, they are dangerous because few investors are focusing on risk. When one feels in the pit of one's stomach the fear that accompanies plunging market prices, risk-taking becomes considerably less risky, because risk is often priced into an asset's lower valuation. Seth Klarman. Difficult markets help us succeed as investors. While claiming no predictive ability to recognize or time the next recession, we are not afraid of periods of slow business and weaker markets. Only in adverse environments do owner-oriented companies with proven track records and strong balance sheets sell at bargain prices. Tough times allow the prepared to attractively deploy capital, setting the stage for future growth. Bruce Berkowitz. Since day one, I emphasized how inevitable stock market corrections are. I even wrote many times that they were partners in our quest for superior returns. So, we should not fear them, but acknowledge right from the start that we will live through many corrections over the years. We should even try to benefit from them as much as we can. Francois Rochan. Over the long term, the S&P looks efficient, but during certain periods we get 50%, 60% downturns. They always say, it's once in a century, but in my 30 years, it seems to happen every 5 or 6 years. It's human nature, so we will have that from time to time, and we just have to be prepared for the opportunity. Li Lu. My dad used to say that every once in a while, the market has to shake out the grocery clerks. It was grocery clerks then, hedge funds now, but they act the same way and panic when the market's down. But instead of selling when the market's down, it's time to buy things cheaply. And when the market is up, it's time to think about selling. Human beings tend to go the other way. That's why having great conviction in what Graham called a fair central value for each current and prospective investment is so important. Bill Stewart. Amidst a swirl of disconcerting events that can feel as though they're spinning out of control, it's natural to want to grab the wheel hard and steer, making wholesale changes to a portfolio, or possibly going to cash. Yet while bold action amidst heightened uncertainty may be emotionally soothing, it is rarely financially rewarding. John Harris. The times when you make the most money is when things really look awful. No one has a rational answer as to how we'll get out of the problems. If you know a company well and have a history of owning it or studied it carefully, you'll see it at a price which is just a crazy price. You couldn't buy at that price before. Glenn Greenberg. It's in the nature of stock markets to go way down from time to time. There's no system to avoid bad markets. You can't do it unless you try to time the market, which is a seriously dumb thing to do. Conservative investing with steady savings without expecting miracles is the way to go. Charlie Munger. Bottoms in the investment world don't end with 4-year lows, they end with 10 or 15-year lows. By Jim Rogers. While 10-15-year lows are not common in the stock market, they may happen. Invest in the stocks of an industry you've researched thoroughly and be ready to see your investment go low before touching new highs. I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. By Warren Buffett. Going against the majority is the true way to make windfall gains in the stock market. This is one place where trying to fit in can be a giant mistake. Among the motivational quotes here, this one by Warren is probably the most famous one on this entire list. The truth is, this simple suggestion by him is extremely hard to follow. The stock market is filled with individuals who know the price of everything, but the value of nothing. By Philip Fisher. People in the stock markets love to look at the historical prices of a share and make buy or sell decisions. This approach is, needless to say, a loss-making approach in the long term and even in the short term. There can be shares that are at an all-time low and are still not worth paying for. There can be shares that have reached their all-time high and still be worth investing in. Philip Fisher's motivational quotes are very popular among slightly more experienced investors. In investing, what is comfortable is rarely profitable. By Robert Arnott. Robert is trying to highlight how important it is to try newer options while investing. Nobody ever made high returns in the stock market without taking risks. In fact, the more risk you take, the more you might earn. But then again, it is risk. The more risk you take, the more you might lose too. Ruber advocates careful, calculated risk-taking. Every once in a while, the market does something so stupid it takes your breath away. By Jim Cramer. Very smart people have tried to understand and predict the movement of the stock markets. And they have failed. The stock markets are very irrational in the short term. You must always be prepared for the unexpected to happen. That is how randomness works. On this list of motivational quotes, this quote by Jim Cramer is more intended as a statement than a quote or advice. Know what you own, and know why you own it. By Peter Lynch. Do not invest in stocks because everybody is talking about them. There is an interesting topic, the circle of competence. This means you should only invest in stocks that you understand. And not just that, understand why you invested in a certain stock at all. There might be times when you might have to sell the stock because it does not suit your investment style. The legendary investor has doled out such great advice to the markets that he has several motivational quotes to his credit. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. By Paul Samuelson. Investing in stocks over a long period of time is as incredibly boring and often involves hard work. It is not as exciting as many think it is. Paul Samuelson wants you to realize not to expect a thrilling experience from investing. For that, he suggests you go to casinos and bet. The 4 most dangerous words in investing are, "This time, it's different," by Sir John Templeton. A track record is of utmost importance. If you are investing a huge chunk of your money in a stock that has a history of poor performance, don't expect very different results. The chances of the stock suddenly changing its nature are minuscule. You get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready, you won't do well in the markets. By Peter Lynch. Recessions can and do happen. In fact, they are unavoidable. If you do not have the courage to stay invested through the ups and downs of the markets, investing in stock markets may not be for you. As mentioned earlier, most of whatever Peter Lynch said became motivational quotes. Wide diversification is only required when investors do not understand what they are doing. By Warren Buffett. This is something new investors may find contradicting. You are advised to diversify your risk by investing in many stocks so that if something bad happens to one stock, you don't lose too much. But the flip side of this is if you invest in too many stocks, you don't get the massive returns from the meteoric rise of a few good stocks. So what Warren Buffett suggests is that once your understanding of stocks is good enough, you should invest in fewer companies. You should still diversify, but avoid over-diversification. Stock market quotes. 1. John Maynard Keynes. As time goes on, I get more and more convinced that the right method of investment is to put fairly large sums into enterprises which one thinks one knows something about and in the management of which one thoroughly believes. 2. John D. Rockefeller. The person who starts simply with the idea of getting rich won't succeed. You must have a larger ambition. 3. Warren Buffett. If you have more than 120 or 130 IQ points, you can afford to give the rest away. You don't need extraordinary intelligence to succeed as an investor. 4. T. Boone Pickens. The older I get, the more I see a straight path where I want to go. If you're going to hunt elephants, don't get off the trail for a rabbit. Top 5 motivational quotes by Indian investors. Let's now see the top 5 quotes from Indian stock market investors. Trading doesn't just reveal your character, it also builds it if you stay in the game long enough. You never know what kind of setup market will present to you. Your objective should be to find opportunity where risk-reward ratio is best. If you do choose to invest in a share, invest for the lifetime. Life seems to be like a stock market, where relationships are traded. Can't judge when the value of a relationship will go high or low. Reaching any goal in trading requires specific domain knowledge and technical skills. But then, after that, it's all mindset management. Yet most people ignore that they automatically think they have that last part all figured out, and it's a mistake. Happy investing. Market fluctuations are your friend, not enemy. Easily one of the most popular stock market quotes by Warren Buffett, the quote states that it is imperative for every investor to understand and look at fluctuations in the market as an ally, not an adversary. Markets are and will continue to be volatile, as history dictates. So, look at a fluctuation as an opportunity. Instead of panicking and selling stocks during a slump, treat a fluctuation as an opportunity to invest in more stocks as they might be cheaper. The 4 most dangerous words in investing are, "This time it's different." Sir John Templeton. This quote works as a perfect reminder that history often repeats itself in the stock market. You might get tempted to relax a bit during a bull run and assume the rules have changed. However, complacency might lead to you getting caught off guard when market conditions shift. A successful investor will always remain vigilant and avoid reckless trading based on the belief that the current situation is unique. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Benjamin Graham. Often considered the father of value investing, Graham reminds us that though market sentiment may cause short-term price swings, it will reflect the intrinsic value of assets in the long run. As an investor, it is therefore important that you consider long-term perspective and make your decisions based on fundamental analysis. Someone is sitting in the shade of a tree today because someone planted a tree a long time ago. Warren Buffett. Another gem by the investing genius, this quote on the share market is all about the importance of patience and long-term investments. Wealth creation is so much more than identifying and investing in the right stocks. It also involves biding your time, allowing your investment to mature, and then reaping the benefits. Practicing patience and remaining invested long-term will allow your money to grow and let you enjoy maximum benefits. The stock market is filled with individuals who know the price of everything, but the value of nothing. Philip Fisher. Quoted by the renowned investor Philip Fisher, this statement highlights the importance of focusing on the long-term value of investments instead of being swayed by short-term fluctuations. It is better to invest in a company with strong fundamentals and growth potential to build true wealth rather than chasing quick gains. Investors should purchase stocks like they purchase groceries, not like they purchase perfume. Benjamin Graham. This quote highlights a very essential aspect of investing: the need for a practical, value-oriented approach instead of an emotional or speculative one. When you purchase groceries, you do so with a practical mindset, choosing items based on quality, utility, and price. Buying a perfume, on the other hand, is a more personal, discretionary decision. Similarly, purchasing stocks must involve a focus on the company's market position, growth potential, and financial health. It is not advisable to make investment decisions based on market hype, short-term trends, or emotion. In investing, what is comfortable is rarely profitable. Robert Arnett. Playing safe may not always work in your favor. Seeking comfort or safety in your investments may not always lead to the most significant returns. To achieve considerable gains, it might be necessary for you to step outside your comfort zone and take calculated risks. The key to making money in stocks is not to get scared out of them. Peter Lynch. A great quote from another legendary fund manager, this statement underscores the importance of staying invested even during market downturns. Fear and panic can lead to selling at the wrong time and missing out on long-term gains. Value stocks are about as exciting as watching grass grow, but have you ever noticed just how much your grass grows in a week? Christopher Brown. A great analogy to convey the importance of value investing. This quote encourages investors to appreciate the potential of value investing, even if it may seem less exciting when compared to speculative strategies. Just as grass grows steadily over time, value stocks may grow in value over the years, even if their progress seems slow in the short term. Like watching grass grow week by week, investors may not notice substantial changes day by day in their investments. However, the cumulative effect of small gains will lead to substantial wealth gains. The single most powerful asset we all have is our mind. If it is trained well, it can create enormous wealth. Robert Kiyosaki. This quote emphasizes on the immense potential of our mental faculties when it comes to achieving financial success. Kiyosaki likens the mind to a dynamic asset with power that can be enhanced through training and education. By continuously training our minds, we can harness their potential to create substantial wealth and achieve our financial goals. This perspective aligns with the idea that education, financial literacy, and personal development are critical components of financial success. It is not the strongest of the species that survive, nor the most intelligent, but the one most responsive to change. Charles Darwin. Yes, this quote has no relation to the stock market. However, it does highlight the importance of adaptability and the ability to fine-tune to changing market conditions. Successful investors are often the ones who can adapt their strategies as circumstances evolve. At the end of cycles, everybody's guard is let down, right? The sense of healthy disbelief erodes, due to fear of missing out. The longer the cycle goes on, the more investors' sense of healthy skepticism erodes, and they begin to believe things that are too good to be true or they don't do the work. That's the ultimate fertile field for financial fraud. People are inundated with capital and they have to put it to work and things ensue. It's as old as financial markets. Jim Chanos. Market extremes represent inflection points. These occur when bullishness or bearishness reaches a maximum. Figuratively speaking, a top occurs when the last person who will become a buyer does so. Since every buyer has joined the bullish herd by the time the top is reached, bullishness can go no further, and the market is as high as it can go. Buying or holding is dangerous. Since there's no one left to turn bullish, the market stops going up. And if the next day one person switches from buyer to seller, it will start to go down. Howard Marks. In the last stages of a bull market, when you have a lot of people making lots of money on all sorts of things that are not within your circle of competence, you must be rational to accept that others are making money in things that are not for you. You must react with equanimity about that and not be affected by the fact that other people are making money and you are not making money in whatever situation. It takes a lot of rationality to do that. It's not that easy to do when those other people make money, when they make what looks like easy money, on things you believe are not good investments. Francois Rochan. As a runaway bull market persists, its relentless vacuum cleaner eventually sucks everyone in. Investors who are skeptical about the perceived overvaluation are forced to watch as their career prospects melt down and security prices melt up. New rationalizations, disguised as rationales, enter the higher levels of discourse to justify jumping, or creeping, onto the asset price train despite disdaining it when it was dozens of percentage points lower. A feeling of fear and acrophobia then becomes replaced by the giddy and disorienting feeling of finally being on track to make money along with the crowd and not feeling isolated in cranky value land. Paul Singer. Very early in my career, a veteran investor told me about the 3 stages of a bull market. Now I'll share them with you. The first, when a few forward-looking people begin to believe things will get better. The second, when most investors realize improvement is actually taking place. The third, when everyone concludes things will get better forever. Why would anyone waste time trying for a better description? This one says it all. It's essential that we grasp its significance. Howard Marks. Common stocks should be purchased when their prices are low, not after they have risen to high levels during an upward bull market spiral. Buy when everyone else is selling and hold on until everyone else is buying. This is more than just a catchy slogan. It is the very essence of successful investment. J. Paul Getty. There's no question that rising prices create their own excitement. So when people see gold go up a lot, if your neighbor owns some gold and you think you're smarter than he is, and you didn't own any, and your wife says to you, how come that jerk next door is making money, and you're just sitting here? It can start affecting behavior. And people like to get in on things that have been rising in price and all of that. But over time, that has not been the way to get rich. Warren Buffett. I have lived through or studied hundreds, possibly even thousands of bull and bear markets. In every bull market, whether it is IBM or Oates, the bulls always seem to come up with reasons it must go on, and on and on. I remember hearing hundreds of times we are going to run out of supply. This time is going to be different. Oil has to sell at $100 a barrel. Oil is not a commodity, he laughs. Gold is different from every other commodity. Well, damn. For 5,000 years it has not been different from every other commodity. Jim Rogers. In a bull market, it is advisable to restrain one's greed. There is an old Wall Street saying, the bulls make money, the bears make money. But what happens to the pigs? You can't make 101%. You shouldn't even strive to make 100%. Your goal should be 66.6% of a big move. Get out and then reinvest in something that has been newly studied. Roy Neuberger. The further you get away from a bear market, the greater the number of people who have convinced themselves they can handle the downside, until the next time, of course. In the interim, if the indices are performing well, then you can bet that many investors, individuals and professionals, alike, are going to feel pressure to do whatever they can to ride the bull. Stephen Romick. Once a bull market gets underway, and once you reach the point where everybody has made money no matter what system he or she followed, a crowd is attracted into the game that is responding not to interest rates and profits, but simply to the fact that it seems a mistake to be out of stocks. In effect, these people superimpose and I can't miss the party factor on top of the fundamental factors that drive the market. Like Pavlov's dog, these investors learn that when the bell rings, in this case, the one that opens the New York Stock Exchange at 9:30 a.m., they get fed. Through this daily reinforcement, they become convinced that there is a God and that he wants them to get rich. Warren Buffett. The longer a benign circle lasts, the more attractive it is to hold financial assets. Those who are inclined to fight the trend are progressively eliminated, and in the end only trend followers survive as active participants. As speculation gains in importance, other factors lose their influence. There is nothing to guide speculators but the market itself, and the market is dominated by trend followers. When a change in trend is recognized, the volume of speculative transactions is likely to undergo a dramatic, not to say catastrophic, increase. While a trend persists, speculative flows are incremental, but a reversal involves not only the current flow but also the accumulated stock of speculative capital. The longer the trend has persisted, the larger the accumulation. George Soros. After a bull market that goes on for years, who is managing most of the money? The bears are all unemployed. They're not managing any money at all. You have a few very flexible smart people, but they run relatively small amounts of money, so they don't matter either. The managers who are relentlessly bullish and who buy more every time the market goes down will be the ones who end up managing most of the money. So, you shouldn't expect a big bull market to end in any rational fashion. Colin O'Shea. Gresham's law says that the bad money, paper, drives the good money, specie, out of circulation. This accurately describes human behavior when people are confronted with a cost-free choice. I now believe this accurately describes people's choice of investment philosophies, especially late in a bull market, when the sloppy analysis drives out the disciplined assessment, and when the grab for return overwhelms the desire for capital preservation. Seth Klarman. A final retrospective thought. When I entered Wall Street in June 1914, no one had any inkling of what the next half-century had in store. The stock market did not even suspect that a world war was to break out in 2 months and close down the New York Stock Exchange. Now, in 1972, we find ourselves the richest and most powerful country on earth, but beset by all sorts of major problems and more apprehensive than confident of the future. Yet, if we confine our attention to American investment experience, there is some comfort to be gleaned from the last 57 years. Through all their vicissitudes and casualties, as earth-shaking as they were unforeseen, it remained true that sound investment principles produce generally sound results. We must act on the assumption that they will continue to do so. Benjamin Graham. After spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this: it never was my thinking that made the big money for me. It was always my sitting. Got that? My sitting tight. Men who can be both right and sit tight are uncommon. I found it one of the hardest things to learn. But it is after a stock operator has firmly grasped this that he can make big money. Jesse Livermore. For as long as I can remember, veteran businessmen and investors, I among them, have been warning about dangers of irrational stock speculation and hammering away at the theme that stock certificates are deeds of ownership and not betting slips. The professional investor has no choice but to sit by quietly while the mob has its day, until the enthusiasm or panic of the speculators and non-professionals has been spent. He is not impatient, nor is he even in a very great hurry, for he is an investor, not a gambler or a speculator. There are not safeguards that can protect the emotional investor from himself. J. Paul Getty. I believe in the golden rule, he said. If one day I find that people are desperate to dump Getty oil stock at less than I know it's worth, then I buy a few 100,000 shares. And if a few years later I find they are keen to buy at almost any price, then I sell them the shares again. John Train quoting John Getty. Outright speculation is neither illegal, immoral, nor, for most people, fattening to the pocketbook. There is intelligent speculation as there is intelligent investing. But there are many ways in which speculation may be unintelligent. Of these, the foremost are: 1. Speculating when you think you are investing. 2. Speculating seriously instead of as a pastime, when you lack proper knowledge and skill for it. And 3. Risking more money in speculation than you can afford to lose. Everyone who buys a so-called hot common stock issue, or makes a purchase in any way similar thereto, is either speculating or gambling. Speculation is always fascinating, and it can be a lot of fun while you're ahead of the game. If you want to try your luck, put aside a portion, the smaller the better, of your capital in a separate fund for this purpose. Never add more money to this account just because the market has gone up and profits are rolling in. That's the time to think of taking money out of your speculative funds. Never mingle your speculative and investment operations in the same account, nor in any part of your thinking. Benjamin Graham. Remain flexible and open-minded about types of investment. There are times to buy blue-chip stocks, cyclical stocks, corporate bonds, convertible bonds, U.S. Treasury investments, and so on. And there are times to sit on cash, because sometimes cash enables you to take advantage of investment opportunities. The fact is, there is no one kind of investment that is always best. Sir John M. Templeton. These crowd madnesses, 1929, recur so frequently in human history that they must reflect some deeply rooted trait of human nature. Perhaps it is the same kind of force that motivates the migrations of birds or the mass performances of whole species of ocean eels. There seems to be a cyclical rhythm in these movements. A bull market, for example, will be sweeping along and then something will happen, trivial or important, and first one man will sell and then others will sell, and the continuity of thought toward higher prices is broken. Bernard Baruch, My Own Street. The first rule of an investment is don't lose money. And the second rule of an investment is don't forget the first rule. And that's all the rules there are. This is the table setter for all of Buffett's comments on investing. The 1985 quote, which sets the philosophical stage for everything that comes afterward, is Buffett's golden rule that capital preservation is the top priority for any investor. While Buffett has certainly backed his share of losing investments, former positions in ConocoPhillips, COP, and Tesco plc, TSCO, L, come to mind, his track record certainly backs up the sentiment that the Berkshire Hathaway portfolio has stacked way more winners than losers. Someone's sitting in the shade today because someone planted a tree a long time ago. As a stock picker whose every portfolio selection makes headlines, Buffett has long preached the importance of patience when building a solid stock portfolio. Taking the long view is as big a deal to Buffett as choosing the best stocks. Price is what you pay. Value is what you get. Buffett is widely celebrated as the greatest value investor of all time, and with good reason. That's exactly why this 2008 quote resonates. Buffett has historically prioritized finding deeply discounted stocks of good, i.e., value, companies and hanging on to them for the long haul. If you can dig up good companies at a low price, you're Warren Buffett's kind of investor. Fear is the most contagious disease you can imagine. It makes the virus look like a piker. Warren Buffett isn't shy about running into financial fires when others are rushing out, as he made clear in this quote from the 2020 Berkshire shareholder meeting. By using the term contagious, the Oracle of Omaha is coyly suggesting that following the herd is no way to find the value-discounted companies that build great investment portfolios. Going where the herd fears to tread, on the other hand? That's a future Buffett bonanza. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. In his 1989 letter to Berkshire Hathaway shareholders, Buffett weighed in on the commitment and faith needed to succeed on Wall Street. By buying a wonderful company at a fair price, Buffett is signaling that once you've done your homework and stepped up to the plate, you can stand firm knowing the company you're buying is worth your commitment and your faith. A simple rule dictates my buying: be fearful when others are greedy, and be greedy when others are fearful. In a 2008 interview with the New York Times, Buffett returns to his theme about fear in investing and, specifically, his firm stance on not following the herd. By encouraging investors to go their own way and not be deterred by temporary headlines, Buffett is laying out his vision for buying low and selling high. If you know your stuff, go ahead and buy when others aren't, and don't be afraid to sell when others are buying. The worst sort of business is one that grows rapidly, requires significant capital to engender the growth and then earns little or no money. Buffett wrote this in his 2007 shareholder letter. He is not a fan of companies that emphasize speed over slow and steady growth and that can't turn a profit, and he said the airline industry is loaded with them. Such companies won't make it into a Berkshire Hathaway portfolio. It's never paid to bet against America. We come through things, but it's not always a smooth ride. Buffett said the above line in a 2009 interview with NBC's Tom Brokaw, as the U.S. began climbing out of the Great Recession. The oracle indicated that the U.S. will take its lumps but always gets up off the canvas ready to fight. Even in a more divided, post-pandemic America, Buffett has made comments publicly that reiterate his confidence in U.S. capitalism. "We love to complain about wherever we are," Buffett told CNBC in 2023. "But the world has changed so much for the better in terms of how well off people are compared to any other time in history. It's man's nature to be dissatisfied, and politics does stir that up. Many know the price of everything, but the value of nothing." Philip Fisher. This quote emphasizes the distinction between price and value. It highlights the importance of understanding a company's intrinsic value rather than just its current stock price. A company's value can also differ by individual depending on their preferences and requirements. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Benjamin Graham. Graham's quote underscores the idea that while market sentiment may drive stock prices in the short term, ultimately, a company's fundamental value will be reflected in its stock price over the long term. The stock market is a device for transferring money from the impatient to the patient. Warren Buffett. Warren Buffett's quote highlights a key principle of successful investing: patience. The stock market is inherently volatile, with prices fluctuating constantly. Impatient investors often react emotionally to these swings, buying high in moments of excitement and selling low in fear. This emotional decision-making leads to losses. Patient investors, on the other hand, understand that market fluctuations are normal. They focus on the long-term potential of their investments, holding on to them through temporary downturns. This allows them to ride out the volatility and ultimately profit from the overall upward trend of the market. Essentially, impatient investors lose money by trying to time the market, while patient investors win by giving their investments time to grow. Risk comes from not knowing what you're doing. Warren Buffett. His quote here highlights the importance of knowledge and research in the markets. Investors who don't understand their investments expose themselves to greater risks. Informed traders can make more calculated, confident decisions. It's like anything else. Flying a Boeing 787 isn't risky if you're trained, experienced, and generally know what you're doing. If it's me flying it, that's hopeless. If you are not a professional investor, if your goal is not to make money significantly above what the world is going to earn, then you ought to just invest in a very low-cost index fund. Warren Buffett. Yes, Buffett again. This quote means that most people don't need to pick individual stocks/securities or try to beat the market. Professional investors spend their careers researching, analyzing, and taking risks to, often, but not always, earn higher than average returns, and even then they often fail. For everyone else, the smartest strategy is simplicity: invest in low-cost index funds that track the overall market. Over time, because businesses earn profits, markets tend to rise. In the case of bonds, because borrowers are contractually obligated to pay their debts, bondholders receive income. Index funds capture that growth with minimal fees and little effort. Instead of taking a guess, predicting, "This is good, this is bad," pointlessly racking up transaction costs and tax bills, and wasting time, for most people, you align your investments with long-term economic progress while keeping costs and mistakes low. To be clear, short-term trading strategies are perfectly viable if you're able to find an edge. But for most people, stock picking isn't relevant. The market can stay irrational longer than you can stay solvent. John Maynard Keynes. This warns that market trends can defy logic for extended periods. Betting on a quick return to fundamentals can lead to losses if irrationality persists. In the end, the price of something is just the amount spent on it divided by the quantity, not necessarily its notional equilibrium value, which is a longer-term consideration, and is subjective. Buy when there's blood in the streets. Baron Rothschild. Clearly, this encourages a contrarian approach to markets. It suggests buying during widespread fear or market crashes, as those are often the best times to find undervalued investments. In terms of modern finance parlance, risk premiums generally expand when prices fall and compress when they rise. Of course, this takes patience. and dollar cost averaging, instead of hanging out in cash, is considered best practices. The goal of a successful trader is to make the best trades. Money is secondary. Alexander Elder. This quote is about focusing on developing and executing a sound trading strategy is more important than the money that might come from trading. It can also secondarily suggest that prioritizing what you enjoy is most important, as whatever you earn is likely to be a byproduct of that. Do not be embarrassed by your failures, learn from them and start again. Richard Branson. Although not specifically about trading, Branson's advice is pertinent, where setbacks and losses are part of the learning process that can lead to greater success. Markets are full of variance and mistakes are common. Nothing goes in a straight line. It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. George Soros. Soros points out the importance of risk and money management in trading, and that winning percentage isn't the most important factor. Making more on winning trades than you lose on losing trades is key to successful trading and investing. To use a baseball analogy, slugging percentage is more important than batting average. Think more in terms of expected value. For example, if you had a hypothetical strategy where you had a 1% chance of being right and a $1,000 reward for being right, and a 99% chance of being wrong, a $1 penalty for being wrong, your expected value is plus $9.01 for every iteration. If assessed accurately, this will work, as long as you can cover the losses or dry spells in the interim. Markets can remain irrational longer than you can remain solvent. John Maynard Keynes. This quote serves as a caution to traders and investors against taking positions that rely on the market quickly correcting an irrational pricing, i.e., such as notional long-term fundamental or equilibrium value, as markets can stay irrational for unpredictable periods. Price is what you pay, value is what you get. Warren Buffett. This quote distinguishes between the price of an asset and its true value. Investors should focus on understanding the underlying value of what they're buying rather than simply looking at the current price, which might not reflect the asset's true worth. Wide diversification is only required when investors do not understand what they are doing. Warren Buffett. Buffett suggests that excessive diversification is a crutch for investors who lack confidence in their investments. Instead, he advocates for focused investing in a few well-understood assets. It, of course, depends on one's knowledge. Those active in their approach will tend to be more concentrated, while those who are passive will tend to diversify more. The stock market is filled with individuals who know the price of everything, but the value of nothing. Philip Fisher. Fisher's quote reinforces the importance of focusing on intrinsic value rather than the day-to-day price movements. Many investors get caught up in short-term prices without understanding the long-term potential of the underlying asset. Diversification is protection against ignorance. Warren Buffett. Buffett argues that diversification is often a way to reduce risk when an investor lacks deep knowledge about specific assets. Especially those from Buffett's time where trading wasn't so computerized, they tend to focus on fewer stocks and know them well rather than spreading their investments too thin. Cut your losses and let your winners run. Jesse Livermore. This advice from legendary trader Jesse Livermore underscores the importance of controlling risk by quickly exiting losing positions while holding on to profitable ones. Cutting losses early, when you realize that something was genuinely a bad decision, prevents small setbacks from becoming large ones, while riding winners maximizes potential gains. It's a fundamental principle in both trading and investing that emphasizes disciplined decision-making. As a rule, panics do not destroy capital, they merely reveal the extent to which it has previously been destroyed by its betrayal into hopelessly unproductive works. John Mills. Financial crises don't actually create losses out of nowhere, but simply expose losses that were already there. During boom periods, investors often pour money into bad or unproductive projects that seem profitable only while confidence and credit are abundant. When liquidity is less ample, those collapse, revealing that much of the wealth never actually existed. It was simply the capitalization of a value, but never was actually backed up. The crisis doesn't destroy real capital. It uncovers the prior misallocation of resources and poor investments that had been hidden beneath speculation, easy money, and excessive optimism. In short, panics reveal, not cause, prior economic waste. The trend is your friend, until the end when it bends. Ed Seykota. Ed Seykota was a pioneer of systematic trading. Here he highlights the importance of following market trends rather than fighting them. Trend-following strategies try to profit from sustained price movements, but they also carry risks when trends reverse. Successful traders know when to stick with the trend and when to exit when the trade meets its goals. Markets are never wrong. Opinions often are. Jesse Livermore. This quote reflects the humility necessary in trading and investing. It warns against becoming too attached to personal predictions, which can lead to stubbornness and losses. The market reflects collective behavior, and traders must respect its signals rather than sticking to rigid opinions. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Peter Lynch. Peter Lynch's quote cautions against market timing and the fear of downturns. Many investors panic and exit the market prematurely. In turn, they miss out on the recovery and growth that often follow corrections. This highlights the value of long-term investing, where staying the course often yields better results than attempting to predict every market fluctuation. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Sir John Templeton. Templeton's quote offers a framework for understanding market cycles. Successful investors recognize the signs of each phase and may adjust their strategies accordingly. Pessimism often presents buying opportunities, while euphoria signals potential market peaks, leading to caution. Do not put all your eggs in one basket. Andrew Carnegie. Carnegie's well-known quote speaks to the principle of diversification in investing. Spreading investments across different assets reduces risk, as a failure in one doesn't jeopardize the entire portfolio. It's a fundamental strategy for risk management and protection against market volatility. You make most of your money in a bear market, you just don't realize it at the time. Shelby Cullum Davis. Davis's quote emphasizes the long-term perspective. Bear markets are challenging, but often present opportunities to buy quality investments at discounted prices. Although these purchases may not immediately show returns, the recovery phase of the market typically rewards patient investors. Alternatively, you might think of bear markets where you learn many lessons on how to develop more robust portfolios. Amateurs think about how much money they can make. Professionals think about how much money they could lose. Jack Schwager. This quote captures the essence of risk management. Amateur traders tend to focus solely on potential profits, while professionals are equally concerned with minimizing losses. In general, professional traders are always thinking about the balance between reward and risk and not overly focused on playing offense. If you go to Minnesota in January, you should know that it's going to be cold. You don't panic when the thermometer falls below zero. Peter Lynch. He's drawing a parallel between the expected cold weather in Minnesota in January and the expected declines that occur in the stock market. Just as Minnesotans are prepared for the cold, investors should expect and be prepared for market downturns. They're a normal part of the market cycle, and panicking during these times can lead to poor decisions. The market is essentially designed to cause traders to do the wrong thing at the wrong time. The market turns our cognitive tools and psychological quirks against us, making us our own enemy in the marketplace. It is not so much that the market is against us, it is that the market sets us against ourselves. Adam H. Grimes. This quote captures the psychological challenges of trading and investing. It suggests that financial markets inherently work in a way that often leads traders to make poor decisions. The market doesn't actively work against us. Rather, it creates conditions that exploit our natural cognitive biases and psychological tendencies, leading us to become our own worst enemy. Human psychology has evolved to make quick judgments, often based on emotion and instinct. For example, heuristics, traits that, while useful in everyday life, can be detrimental in trading. For example, cognitive biases like loss aversion make people fear losses more than they value equivalent gains, often leading traders to hold on to losing positions too long, hoping for a rebound. Similarly, recency bias, where recent events are weighted more heavily than long-term trends, can lead traders to believe a trend will continue just because it has been present in the short term, leading to irrational trading decisions. Traders also tend to buy when prices go up, out of excitement or fear of missing out, thinking they're good rather than more expensive, and get spooked and sell when things go down, when they're getting cheaper. So, they do basically the opposite of what they should be doing. We covered in a separate article how the best traders tend to be the ones that forgot about their accounts or passed away. Grimes' insight is particularly relevant in volatile or uncertain markets, where price movements can seem irrational or unpredictable. Such environments trigger emotions like fear and greed, which can cloud judgment and lead to impulsive actions. To counteract these tendencies, Grimes' message implies that traders have to cultivate self-awareness, discipline, and some sort of systematic approach that tempers emotional responses. Whenever I make an investment decision, I observe myself making it and think about the criteria I used. I ask myself how I would handle another one of those situations and write down my principles for doing so. Then I turn them into algorithms. I am now doing the same for management, and I have gotten in the habit of doing it for all my decisions. Ray Dalio. Dalio emphasizes a structured approach to decision-making in this quote. He describes how he observes his own thought process when making investment decisions, analyzing the criteria he considers and the steps he takes. This helps him understand the reasoning behind his choices, which enables him to identify patterns and principles that guide his actions. Whenever we make a decision, there's something going on in our heads that's causing us to make these decisions. So why not write down the criteria and stress test it to make it good? Accordingly, he aims to codify his thought process into clear principles. From documenting these principles, he creates a foundation for handling similar situations in the future. This method of turning principles into algorithms helps with much better consistency and objectivity in his decision-making. Dalio then applies this practice not only to investment but to management and all areas of his life, looking to make his decision-making as systematic and reliable as possible. Overall, from formalizing his thinking into principles, decision-making criteria, and then algorithms, where possible, Dalio builds a framework that allows him and others to benefit from his experience, making his decision-making process more transparent, systematic, i.e., replicable, and efficient. The greatest mistake of the individual investor is to think that a market that did well is a good market rather than a more expensive one. Ray Dalio. Dalio highlights a common pitfall among individual investors, mistaking past market performance as an indicator of future value. When a market performs well, investors often assume it's inherently good, leading them to invest more heavily. However, Dalio warns that a strong-performing market is usually more expensive, meaning assets are pricier, which reduces potential returns. Instead of viewing a successful market as safe, investors should consider its current valuation and future potential. Future returns are often dependent on the current pricing. This perspective encourages critical analysis over emotional decision-making and avoiding costly mistakes tied to past performance alone. All investments compete, and it's not easy to tell whether one investment is better than the other. Because if people could do that, life would be easy and everybody would make a ton of money, and this is a competitive game that's very difficult to compete in. Ray Dalio. Dalio emphasizes the inherent challenge in choosing between investments/trades, emphasizing that all of them are in constant competition for capital. Determining which investment is superior isn't straightforward. If it were, investing would be simple, and everyone would profit effortlessly. The competitive nature of trading and investing stems from the complexity and unpredictability of markets. Traders and investors have to constantly assess risk, return, and timing, and rarely with perfect information. This competitive game is difficult precisely because markets are influenced by countless variables, economic trends, company performance, global events, with all sorts of variance associated with them. Every trader is trying to gain an edge, and success requires a blend of strategy, skill, and luck. Dalio's insight highlights that achieving significant returns isn't just about picking good trades or investments, it's about understanding the competition and the complexity of markets. The upshot is that most should have the bulk of their capital in passive, diversified strategies for best results. But when I mean financial engineering, I don't mean go into an optimizer and throw things around and see what spits out. I mean understanding the parts and how to put those parts together. Ray Dalio. Ray Dalio emphasizes a thoughtful approach to financial engineering, contrasting it with a more superficial, formula-driven method. When he talks about financial engineering, he doesn't mean merely using optimization software to experiment randomly with different variables or backtesting the recent past until a desirable outcome appears. Instead, he advocates for a deep, fundamental understanding of the elements involved in financial decisions and how they interact. Dalio's approach requires comprehending the specific characteristics, risks, intrinsic correlations, and behaviors of individual investment assets or strategies. He encourages investors to consider how different financial parts, such as stocks, bonds, commodities, and cash, work in relation to one another, rather than simply relying on software to generate portfolios without deeper insight. This level of understanding enables traders and investors to build a cohesive, balanced strategy based on knowledge rather than luck or suboptimal, generic optimization. Knowing how different assets respond to various economic environments, they can engineer a portfolio that withstands different market scenarios. Dalio's perspective emphasizes strategic design over trial and error experimentation, looking for purpose and resilience in financial planning. In his view, successful financial engineering relies on insight and intentionally, not just on algorithms or formulas without the deep understanding. I'm actually as proud of the things we haven't done as the things I have done. Steve Jobs. In markets, it's often thought that success comes action and making a lot of moves, buying, selling, timing every swing. But some of the best decisions are the ones you never make. Choosing not to chase a hot stock at its peak, not to jump into a trade just because everyone else is, not to risk money on something you don't fully understand. Most people just passively invest. Then think about how many professionals don't beat the benchmark. Yes, it's not always the goal, but it's true for most mutual funds, which are trying to beat a representative benchmark. Those non-decisions protect capital just as much as good trades grow it. Saying no to bad setups, overhyped trends, or businesses that don't fit your strategy helps you avoid unnecessary losses. And those avoided losses compound just as powerfully as your gains. So in trading and investing, you can be proud not only of the stuff you bought or the trades you nailed, but also of the ones you walked away from. Sometimes the smartest move in markets is no move at all. The first rule of compounding is to never interrupt it unnecessarily. Charlie Munger. Compounding works best when gains are left to build on themselves over long periods. Constantly buying, selling, or reacting to short-term market swings interrupts this process and reduces long-term growth. Even small breaks in compounding can have a big impact, since time is the key multiplier. Munger's point is that investors often sabotage themselves by over-managing, chasing quick wins, or panicking during downturns. The real power comes from staying invested, letting compounding do the heavy lifting, and resisting the urge to interfere. For most people, that probably means no stock picking, no market timing, no checking prices. Sometimes the wisest action is no action at all. Markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected. George Soros. The obvious is already priced in. Stock and asset prices already reflect the collective knowledge, expectations, and sentiment of millions of participants. If something is widely known, a strong earnings report, a rate hike, or a booming industry, it's likely already embedded in the current price. Buying or selling on that information won't give you an edge. The real opportunities come from recognizing what others don't see or what they misinterpret. Outperformance depends on anticipating surprises or finding pricings that can't logically coexist. Successful traders and investors look beyond the headlines and search for mismatches between perception and reality. This means identifying situations where the consensus is wrong or incomplete. The market rewards those who can step past the obvious and position for outcomes that aren't fully appreciated. I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 10 years. Warren Buffett. Buffett's quote gets to the core of his philosophy. He doesn't see stocks as lottery tickets or short-term bets, but as ownership in real businesses. If you'd be comfortable holding a company for a decade without checking the price, it means you believe in its long-term strength, durability, and ability to create value. This mindset frees you from obsessing over daily/weekly/monthly/quarterly, even annual, market swings, which are often just noise, i.e., transactive activity that isn't relevant to the long-term earnings that most investors are looking for. Instead, it shifts focus to fundamentals, like earnings power, management quality, and competitive advantage, because those are what truly compound over time. Don't look for the needle in the haystack. Just buy the haystack. Jack Bogle. This sums up the beauty of index investing. Instead of stressing over which stock will beat the market, you simply own the market itself. Holding everything means you capture the winners without having to predict them in advance. Major indexes also benefit from survival bias. They kick out underperformers and add good performers automatically according to predefined criteria. Over time, compounding works in your favor, and you avoid the costly mistakes that come with endless stock picking. Simplicity often outperforms complexity. Risk is what's left over when you think you've thought of everything. Carl Richards. This is a nice reminder of the limits of control in markets. Investors often build models, run scenarios, and convince themselves they've accounted for every possibility. But markets have a way of exposing blind spots. True risk isn't in what you already know or can easily plan for. It's in the surprises you didn't see coming. Models are ultimately simplifications of reality. No model can capture every variable, every shock, or every chain reaction that ripples through economies and markets. The 2008 financial crisis, the pandemic, or sudden policy shifts, all were outside what most investors had planned for. Richard's point is humbling. Risk never disappears, it often hides in places you're not looking. The takeaway isn't to avoid markets, but to respect uncertainty. Diversification, discipline, and humility are the best defenses, because what truly hurts portfolios is rarely what's expected, but what arrives unannounced. Ultimately, try your best to understand risk and control it. I can't change the direction of the wind, but I can adjust my sails to always reach my destination. Jimmy Dean. This quote highlights the importance of adaptability in trading and investing. Economies and markets are constantly changing, and being rigid in your approach can lead to very suboptimal results. Successful traders and investors adjust their strategies to align with market dynamics to achieve their financial goals. The only true wisdom is in knowing you know nothing, Socrates. In the context of trading and investing, this quote emphasizes the value of humility and continuous learning. Markets are complex with very high levels of dimensionality, many input variables affecting the output, and overconfidence in one's knowledge can lead to risky decisions. Acknowledging the limits of your understanding encourages a cautious approach and openness to new information and strategies. In flying, I have learned that carelessness and overconfidence are usually far more dangerous than deliberately accepted risks. Wilbur Wright. This quote can be related to risk management in trading and investing. Carelessness and overconfidence can lead to neglecting risk management principles and significant losses. On the other hand, successful traders and investors carefully assess and accept risks, and implement strategies to manage and mitigate them effectively. Risky things, like flying an airplane or trading markets, aren't necessarily risky as long as the risks are understood and controlled for. There are no beautiful surfaces without a terrible depth. Applied to trading and investing, this quote suggests that opportunities that appear attractive on the surface may involve hidden risks or complexities. It emphasizes the importance of thorough research and analysis to understand the underlying factors that may impact an investment's, trades, or position's performance. All things are subject to interpretation. Whichever interpretation prevails at a given time is a function of power and not truth. In the financial markets, this quote underscores the subjective nature of market analysis and the influence of market sentiment. Different traders/investors, or algorithms, may interpret the same information differently. Market movements often reflect prevailing sentiments or the actions of big/powerful market participants rather than objective truths. The price of anything is the money and credit spent on it divided by the quantity. It doesn't have to reflect fundamental value, as that's a much longer-term consideration. The surest way to corrupt a youth is to instruct him to hold in higher esteem those who think alike than those who think differently. This quote highlights the importance of diversity of thought in trading and investing. Echo chambers can lead to narrow thinking, missed opportunities, and increased risk. Valuing and considering different perspectives and strategies can enhance decision-making and lead to better trading/investment outcomes. Markets are inherently a mix of various perspectives, so it's a good idea to understand who are the buyers and sellers, how influential they are, and what they're motivated to do. The individual has always had to struggle to keep from being overwhelmed by the tribe. This quote reflects the challenge of independent thinking in the face of market consensus or herd behavior. Successful traders and investors often have to go against the crowd and make decisions based on their analysis, information, and convictions rather than simply following popular trends. Going against the crowd is necessarily to generate alpha. In individuals, insanity is rare, but in groups, parties, nations, and epochs, it is the rule. Applied to trading and investing, this quote warns against the irrationality that can prevail in markets, especially during bubbles or panics and downturns. It underscores the need for rational, disciplined trading/investment approaches that resist getting caught up in the euphoria or despair of the masses. It is hard enough to remember my opinions, without also remembering my reasons for them. This quote humorously points to the importance of having clear rationales for trading/investment decisions. Keeping track of the reasons for your trades or investments helps in evaluating their outcomes and learning from your experiences. This can contribute to growth and improvement in your trading or investing strategy. Let's suppose you have a coin that is 70-30 heads. Well, if you get to bet heads, you are going to win 7 times out of 10. 3 times out of 10 you are going to lose, and that's bad luck. So you need a measure of good luck to avoid a long run of tails when you have a 70-30 coin that's heads. At a certain point the luck evens out. Of course there's luck in our business, but so far we've had a nice edge. Jim Simons. This is a good quote that talks about the variance involved in markets and how it takes not only an edge but a large enough sample size to realize it. Related, how long to test a trading strategy? It uses the analogy of a biased coin to illustrate the role of luck and edge in trading. Even with a statistical advantage, like a coin biased towards heads, there will be periods of losses due to random fluctuations. Managing risk and surviving these drawdowns is important to realizing the long-term benefits of the edge. The quote acknowledges the presence of luck, but emphasizes the importance of having a strategy that provides a consistent advantage over time. This highlights the need for both statistical analysis and sound risk management to navigate the inevitable ups and downs of the market. No model is correct. Pick the one that's useful. Emmanuel Derman, former Goldman Sachs quant, author of Models.Behaving Badly. Derman, a physicist turned quant, points out the limitations of financial models. He argues that models are simplified representations of a complex reality, not perfect replicas. No model can fully capture all the variables, nuances, and unpredictability of markets. Instead of seeking an ideal model, traders and investors have to focus on finding models that are useful, those that provide insights, identify opportunities, and manage risks, even if they aren't entirely accurate, which it's virtually impossible to be. This pragmatic approach acknowledges that all models have flaws, and the key is to select and use them effectively in light of your particular goals, understanding their strengths and weaknesses in a nuanced way. We don't start with models. We start with data. We don't have any preconceived notions. We look for things that can be replicated thousands of times. Jim Simons. Rather than parametric theoretical models onto the market, Simons and his team at Rentech began by analyzing large amounts of data, terabytes per day, searching for patterns and signals. They avoid preconceived ideas or biases, letting the computer models guide their strategy development. The emphasis on replicability is important. They seek patterns that occur consistently, indicating a strong relationship rather than a random fluke. This is important in trading. You don't want your strategy to be highly tactical and dependent on spotting things that are likely to never repeat themselves, or at least not repeat themselves consistently. This approach is central to their success in identifying subtle market inefficiencies. Patterns of price movement are not random. However, they're close enough to random so that getting some excess, some edge out of it, is not easy and not so obvious. Jim Simons. While markets may exhibit some predictable patterns, they are often obscured by noise and randomness. There are all sorts of different buyers and sellers, of all types of sizes, with many different types of motivations for doing what they're doing. Extracting a consistent advantage, edge, requires sophisticated techniques to identify these subtle signals. It's not a simple task, as markets are complex adaptive systems influenced by countless factors. There's no such thing as the goose that lays the golden egg forever. Jim Simons. This quote is a reminder that no trading strategy or investment approach works indefinitely outside the obvious. For example, holding a diversified portfolio of stocks and bonds over long periods of time. Successful traders, investors, and business people have to be adaptable, constantly refining their models and searching for new opportunities as markets evolve. The most painful lesson that was repeatedly hammered home is that you can never be sure of anything. There are always risks out there that can hurt you badly, even in the seemingly safest bets, so it's always best to assume you're missing something. Ray Dalio. Dalio emphasizes the importance of humility and recognizing the inherent unknowns in markets. Even when things seem safe, hidden risks can exist. There's what we know, which isn't much compared to what's already discounted in the price. There's what we know we don't know. And there's what we don't know that we don't even know that we don't know. Amateur traders have a tendency to be far too certain. Those with more expertise have a better understanding of what they don't know and can't know. So, there's always the need for continuous learning, critical thinking, and a healthy dose of skepticism to avoid complacency and potential losses. Investment systems built on machine learning that is not accompanied by deep understanding are dangerous because when some decision rule is widely believed, it becomes widely used, which affects the price. In other words, the value of a widely known insight disappears over time. Ray Dalio. Dalio cautions against blindly relying on machine learning models in trading. Here's why. Overcrowding. When a profitable pattern is discovered, many people exploit it. This pushes prices up for buying or down for selling, eroding the original advantage. Self-defeating prophecy. The strategy works because it's not widely known. As it gains popularity, the market adjusts, and the edge vanishes. Black swans. Models are trained on past data, though the algorithms are not necessarily derived that way. Unexpected events, like a pandemic, can cause markets to behave in ways the model never anticipated. It ultimately can't react to something that's not accounted for in the system. Essentially, widely known things get priced in, becoming useless as a source of outperformance. True, lasting success requires deep understanding of why something works, allowing you to adapt when the rules of the game change. We would need to make sense of the formulas the computer produces, of course, to make sure that they are not data mined gibberish, by which I mean based on correlations that are not causal in any way. Ray Dalio. This quote stresses the importance of human oversight in algorithmic trading. Machine learning can identify correlations in data, but it can struggle with causation. Humans must analyze the output, so the model's logic is sound and not based on spurious relationships. Of course, given our brain's limited capacity and processing speed, it could take us forever to achieve a rich understanding of all the variables. Ray Dalio. Dalio acknowledges the limitations of human cognition. The sheer volume and complexity of market data can overwhelm our ability to process it effectively. We simply can't process the enormous amount of information fast, accurately, and less emotionally than a well-programmed computer can. This underscores the need for tools and systems to augment our understanding, but not replace our critical judgment.